What if the next financial crisis has already started? Not with a crash, not with headlines, but quietly in the background. According to recent financial reports and global institutions, warning signs are beginning to appear. So the real question is, are we early or already too late? To understand what's happening now, we need to look at how the system works. The global economy runs on credit. Companies borrow, governments borrow, consumers borrow. And for years, borrowing was cheap. According to central bank data, interest rates stayed historically low after the 2008 financial crisis, fueling growth across markets. This created a long period of expansion, but it also built something else, a system heavily dependent on debt. Over time, debt levels grew significantly. According to global financial data, corporate debt, government debt, and consumer debt all increased across major economies. Markets expanded, asset prices rose, companies leveraged cheap money to grow faster. New financial systems, like private credit, also expanded rapidly. For years, this environment supported strong growth. Everything appeared stable until conditions began to change. Then came a major shift. Interest rates started rising globally. According to central bank policies and financial reports, borrowing became more expensive. This changed everything. Companies with high debt now faced higher costs. Consumers faced rising loan payments, and growth began to slow. At the same time, reports from institutions like the IMF highlighted increasing vulnerabilities in certain sectors, especially those with high leverage. These weren't failures, but they were early warning signs. As conditions tightened, more signals started appearing. According to financial media and market data, some companies began struggling with debt repayments. Default rates increased in certain segments. Real estate markets slowed in multiple regions, and zombie companies, firms surviving on debt, faced growing pressure. At the same time, experts pointed out that some risks may be harder to see. Private markets, complex financial structures, interconnected systems, not collapsing, but building pressure. So where do things stand today? The global economy is still functioning. Markets are still active. Companies are still operating. But according to recent reports and expert analysis, the level of caution has increased. Central banks continue to monitor inflation and stability. Financial institutions are watching risk levels more closely. There is no confirmed crisis, but there is growing attention and rising concern. So, what does this mean for you? Financial crises don't usually start with a single event. They build over time, through pressure, through hidden risks, through systems that seem stable until they're not. The key lesson? Pay attention to the signals, because by the time everyone sees the problem, it's often too late. Are these just normal economic cycles, or the early signs of something bigger? The global economic landscape is complex, with many moving parts. It's a web of interdependencies where a change in one area can ripple across the system. For now, the focus remains on monitoring these ripples before they grow into waves. The question is not just when, but how these movements will shape the future of global finance. In this complex dance of numbers and trends, the stakes are high. The signs are there, and the story is just unfolding. As the global economy navigates these uncertain waters, several key factors demand our attention. First, let's delve into the role of central banks. Historically, these institutions have acted as stabilizers, adjusting interest rates to control inflation and stimulate growth. However, in recent years, their roles have expanded. Central banks like the Federal Reserve, the European Central Bank, and others have implemented unconventional monetary policies, such as quantitative easing, to inject liquidity into the markets. Quantitative easing, or QE, involves central banks purchasing government bonds and other securities. While this strategy has helped stabilize economies post-crisis, it has also led to unintended consequences, asset bubbles in real estate and stock markets being some of the most notable. Critics argue that these policies have disproportionately benefited the wealthy, widening the gap between the rich and the poor, a dynamic that can exacerbate economic instability. Meanwhile, geopolitical tensions add another layer of complexity. Trade wars, such as those between major economies like the United States and China, have introduced new risks to global supply chains. Tariffs and trade barriers can lead to increased costs for consumers and businesses, potentially stifling growth. Additionally, regional conflicts and political instability in areas like the Middle East can affect global oil prices, further influencing economic conditions. Against this backdrop, technological advancements are reshaping industries at an unprecedented pace. Automation and artificial intelligence are transforming labor markets, potentially displacing workers and altering traditional economic models. On one hand, these technologies promise increased efficiency and productivity. On the other hand, they pose significant challenges to employment and income distribution, raising questions about the future of work. Consider the rise of fintech and cryptocurrencies. Digital currencies like Bitcoin and Ethereum have introduced new financial paradigms. They challenge traditional banking systems. While they offer potential for greater financial inclusion and innovation, they also bring regulatory challenges and volatility. The recent rapid fluctuations in cryptocurrency values highlight the speculative nature of these assets. This poses risks to investors and stability. Moreover, the shadow banking system continues to grow. It comprises financial entities like hedge funds and private equity firms. These entities operate outside conventional banking regulations. They often engage in riskier investments. Their lack of transparency can obscure potential vulnerabilities within the financial system. The interconnectedness of these entities with regulated banks means that distress in shadow banking could have far-reaching effects. Amid these evolving dynamics, consumer confidence plays a crucial role. It serves as an indicator of economic health. High levels of consumer confidence typically correlate with increased spending and investment. However, shifts in confidence can signal changes in economic conditions. For instance, a sudden decline may suggest looming trouble as consumers cut back on spending. This could potentially trigger a slowdown. In response to these multifaceted challenges, governments and policymakers are tasked with balancing growth and stability. Fiscal policies, such as government spending and taxation, are tools used to influence economic activity. In times of economic downturn, increased public spending can stimulate demand. Tax cuts can leave consumers with more disposable income. However, these measures must be carefully calibrated to avoid exacerbating fiscal deficits and debt levels. International cooperation is also pivotal. Global economic issues often transcend borders, requiring coordinated efforts from countries and institutions. Organizations like the International Monetary Fund and the World Bank play critical roles in facilitating dialogue and providing financial support. Their involvement can be instrumental in stabilizing economies and preventing crises from spreading. As we navigate this interconnected world, the stakes are high. The next chapter of this evolving economic narrative remains unwritten. There is potential for both opportunity and risk. The key players, central banks, governments, businesses, and individuals are all part of this intricate dance. Each action influences the broader landscape. This ongoing story is about more than just numbers and markets. It's about people, livelihoods, and the future of societies. As these complex dynamics unfold, they will shape the trajectory of economies across the globe, leaving us to ponder not just the immediate implications, but the long-term impact on generations to come. As we look to the future, it's crucial to consider the resilience of financial systems. Stress tests conducted by central banks are designed to gauge how well banks can withstand economic shocks. These tests have become more rigorous over the years, reflecting the growing complexity of financial markets. However, the ever-evolving nature of potential threats means that even the most robust models may not fully predict where vulnerabilities lie. Simultaneously, the role of sustainable finance is gaining prominence. With climate change presenting a formidable challenge, investors are increasingly focused on environmental, social, and governance (ESG) factors. Sustainable investing not only aims to generate financial returns, but also considers long-term impacts on society and the environment. This shift is driven by growing awareness and demand from consumers who prioritize ethical considerations in their financial choices. Furthermore, the rise of digital finance has democratized access to financial services. Fintech platforms are enabling people in underserved regions to participate in the global economy, offering services like mobile banking and microloans to those previously excluded from traditional financial systems. This democratization holds promise for reducing inequality and fostering inclusive growth. Yet, with these advancements come new risks. Cybersecurity threats loom large as financial systems become more digitized. Protecting sensitive data and preventing cyber attacks are critical to maintaining trust in the digital financial landscape. As these diverse factors converge, the path ahead remains uncertain. However, one constant remains: the need for vigilance and adaptability in the face of change. In this intricate web of global finance, the ability to anticipate and adapt will determine resilience against the next potential crisis.